113,000 COMEX silver contracts exist against only 88 million ounces registered. Those numbers rarely sit together quietly for long. The ratio between paper and vault metal is tightening again. That is where today's story begins. Oggijon AG here. Drop Oggijon AG in the comments if you are here paying attention and actually learning. The ones paying attention already know this pattern appears before stress events. Western paper demand keeps climbing while vault stocks shrink. That combination deserves scrutiny today. Now silver traders are watching the same numbers again. Let's get straight into it. The COMEX silver open interest, it's near 113,000 contracts today. Each contract represents 5,000 ounces of silver exposure. That equals roughly 565 million ounces in paper positioning. COMEX registered silver inventories now sit near 88 million ounces. CME Group publishes those vault figures daily. Think about the ratio between those two numbers carefully. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to Oggijon AG 1.0. And share this with one person who needs to see these numbers. Now back to the data. Lead story today. CME Group COMEX silver positioning. Open interest approaches 113,000 active futures contracts. COMEX registered silver inventories show roughly 88 million ounces available. That data comes directly from CME Group warehouse reports. The leverage between contracts and physical metal continues expanding. Effective this week's settlement reports. This follows multiple months of steady vault withdrawals. Registered inventories exceeded 150 million ounces 3 years ago. Today they sit far below that level. The pace of drawdowns slowed recently but never reversed. The unusual detail is contract growth. Returning simultaneously, paper demand rises while vault metal remains constrained. The timing is what deserves scrutiny, not the numbers themselves. The timing, think about what that sequence actually means. Large traders increase exposure during declining physical supply. That pattern appears repeatedly before volatility spikes. Could this pressure continue building quietly underneath current prices? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time silver open interest exceeded vault coverage ratios like this, volatility followed quickly. Western futures positioning expanded sharply during 2020 and 2011 rallies. The data is already telling you something. Now let's build the full picture, because COMEX positioning never exists in isolation. The U.S. Commodity Futures Trading Commission publishes Commitment of Traders reports weekly. That report shows commercial and speculative positioning breakdowns. CME Group publishes daily open interest totals for every futures contract. The London Bullion Market Association publishes vault inventory estimates monthly. The Shanghai Gold Exchange reports physical withdrawals from Chinese markets. Those four institutions define most transparent silver market data globally. The CFTC Commitment of Traders report shows hedge fund longs expanding recently. Managed money long contracts increased during the latest reporting cycle. At the same time, commercial hedgers maintain large short exposure positions. Those shorts represent mining companies and bullion banks primarily. The balance between those two sides creates futures price pressure. Meanwhile, LBMA London Vault reports show inventories declining slowly year over year. Shanghai Gold Exchange withdrawals remain historically elevated as well. China remains the largest physical silver buyer globally. Those withdrawals remove metal from Western tradable supply chains. The rate of physical movement is not slowing. It is quietly compounding underneath stable futures prices. The data is doing the talking. The ones who were called alarmists for pointing at inventory drawdowns stay quiet today. The ones who verify do not argue about it, and here is what makes that picture even harder to ignore. COMEX open interest represents more than 6 times registered vault supply today. That ratio occasionally rises much higher during extreme conditions, but sustained ratios above 5 deserve attention. At the same time, total silver mine production globally remains roughly 820 million ounces yearly. The Silver Institute publishes that estimate annually. Industrial demand continues expanding due to solar manufacturing growth. Photovoltaic production uses increasing quantities of refined silver annually. At the same time, Western investment demand cooled slightly last year. That combination creates a confusing structural picture for traders. That is not a contradiction, that is the setup. And before anyone takes that as a green light, understand something important. Setups can take years before resolving into price action. Structural pressure builds slowly in commodity markets frequently. What this data describes is a structural imbalance developing gradually. The timing question remains completely separate from that structure. Anyone claiming to know the timing is selling something. Here is the number most people ignore today. Global solar installations consumed roughly 160 million ounces of silver last year. The International Energy Agency tracks solar capacity expansion worldwide. Solar demand alone equals nearly double current COMEX registered Inventory levels. Now, energy transition policy becomes a primary variable for silver demand. Governments subsidize renewable installations across the United States, Europe, and China. The Inflation Reduction Act expands U.S. solar incentives significantly. China installed over 200 gigawatts of solar capacity recently. That data comes from China's National Energy Administration. Each gigawatt of solar capacity requires substantial silver paste inputs that create structural industrial demand regardless of investment flows. Markets currently price silver largely as a monetary metal. Industrial demand rarely dominates futures narratives until shortages appear. Look at solar installation projections through 2030 carefully. The International Energy Agency projects continued rapid solar expansion globally. If those projections hold, physical silver demand rises steadily. Markets currently price stable supply conditions across the decade. Look at mine production growth projections and question that assumption. Environmental permitting delays slow new mining projects worldwide. Every time energy transitions accelerate commodity demand, spikes eventually follow. It has not been different yet. Silver Western spot trades near $26 per ounce currently. Shanghai futures exchange prices often trade slightly above Western benchmarks. That premium fluctuates depending on Chinese physical demand conditions. The short-term price picture remains messy across most time frames. Volatility increased without clear directional momentum recently. Futures traders react more to interest rates than physical flows currently. If real interest rates remain elevated, silver struggles to rally aggressively. If global monetary policy loosens again, silver benefits historically. That is the only short-term read that matters right now. As for trading it, the lower time frames remain noisy. Clear directional structure does not exist today. Nobody knows tomorrow's closing price. Anyone claiming certainty is guessing with confidence. Current market conditions remain macro-driven rather than supply-driven. Sidelines is not weakness in this environment. It is the only edge there is. Silver rallied sharply several times during the last decade. It also corrected violently during tightening cycles repeatedly. Those cycles remind traders to respect uncertainty constantly. The tape decides, not me. Here is the honest truth. Both sides of this trade have credible arguments today. Ignore one side and risk grows immediately. The bear case is real. Real interest rates remain positive. Across most developed economies today, the U.S. Federal Reserve policy rate exceeds 5% currently. A strong U.S. dollar historically pressures precious metals prices downward. Global manufacturing surveys show slowing industrial activity in several regions. The bull case is equally real. COMEX registered inventories remain historically tight versus futures exposure. Solar manufacturing continues expanding silver demand structurally each year. China and India maintain strong physical bullion import demand trends. Size correctly, know what you are in before you are in it. The physical market already understands these structural pressures quietly. The paper market still debates macro narratives every week. That argument does not last forever. Everything discussed today points toward one unavoidable reality. Structural pressure builds slowly before markets recognize it suddenly. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group, Warehouse Reports, U.S. Commodity Futures Trading Commission Commitment of Traders Reports, London Bullion Market Association Vault Statistics. The data is public and transparent, logic over hype, always. If this analysis added value like this video right now, subscribe to John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the John AG 1.0 playbook do not wait. They verify the data themselves and act accordingly. The ones paying attention already know that discipline matters. Sit with that. John AG 1.0 out.